Hello there, I'm Guto Harri. I do a lot of TV commentary these days. I've been a business correspondent at the BBC based in New York for a while, covered companies in the UK, and worked in many a boardroom over the years, as well as in politics. And I'm here today to talk to one of the most experienced people in his industry, Bill Nixon, who has decades of experience in financial services, has handled the Maven VCTs, since 2004, is currently the founder and managing partner of Maven itself. And Bill, we're here today to talk about a choice that has to be made this summer between two groups of people to take a company forwards and two very distinct strategies. And it's a pretty contentious choice, one which you obviously have strong feelings about. Tell us a bit about how we got here, what the stakes are, and what do you think shareholders should be thinking about?
So good to get the opportunity to talk to you today about the Maven Renovar VCT, which was formerly branded the Amati AIM VCT. So the background to this case and the requisition that we're discussing today is that the board of the VCT, the independent board, decided in March 2024, last year, to begin a strategic review process. And the reason they did that was because performance had been weak. The share price had been in steady decline. The type and quality of companies coming into the portfolio had been suboptimal, and performance had suffered as a result. The manager had also diversified into private equity and had lost just over 9 million in 3 private equity deals. And the board felt at that stage it had to act. And following the completion of the strategic review process, where a number of managers were beauty paraded, Maven was appointed the fund manager on the 1st of May this year. Subsequent to that, and Amati being paid termination fee, the former fund manager and certain associates have requisitioned a general meeting with just over 5% of the equity, and shareholders will have the opportunity to vote on that in the coming days and weeks.
How hefty was the termination fee?
So the Amati were paid a termination fee of about 1.1 million. Conversely, Maven has agreed to take on this project for no management fees for 2 years, and that's to demonstrate our commitment to this turnaround project. And interestingly, as a comparison, we have taken on a very similar project. I can remember back to 2008 to 2010, when similarly the AIM market was very challenged. I think it's even worse now. There are serious structural issues. There's a lack of companies coming to the market. There's been a change of the available tax reliefs. There's many companies delisting. So AIM is going through a really difficult period, and it's difficult to say a way through this. So I can well understand why any board would see an AIM-only strategy as one that was viable for investors. This is not just about an equity rally. This is not a case of a market being depressed and the share price or certain companies recovering in due course. You know, our analysis of the portfolio shows that over the last few years, 23 of the 23 investments completed for the Renovar VCT, 20 were actually declined by us. So it's the underlying quality of recent investments that's the primary issue. And a lot of money has been raised for the VCT in the last few years. The early portfolio is a good portfolio. There are some good investments there. But a lot of capital has been raised in recent years, and a combination of that and a lower quality of company being selected for the portfolio has led to a dilution of early investor returns and a share price, significant share price decline.
I suppose what others would say is that when so many of the prices are depressed, it is essentially a good time to buy. You don't think that is going to work, and if people think that, they're going to get burnt again.
Well, at the end of the day, it's very difficult to second judge equity markets. I think I've made the point that, you know, we don't think an equity rally would have a significant impact on the underlying share price of a large number of the portfolio companies. We look at up to 25 or possibly 30 of those companies that are underperforming or materially underperforming relative to plans. So it's an overly simplistic approach to say this is a low point in the market and it's going to recover. That may happen. But if you look at the macros that are affecting AIM at the moment, the delistings, the reduction in tax relief, the lack of quality companies coming to IPO, there are very few good macros that would suggest that the market and the fund value is likely to recover short term.
And I guess then that's what drives you to say, yes, keep the good ones, but actually the only future with happy results essentially is to focus on AIM Plus and to start building something else alongside what you hang on to.
Absolutely, Guto. That summarizes it perfectly. Now, it's important to stress that this is not a question of us wholesale selling the AIM portfolio. There are some good older companies in the AIM portfolio and suddenly moving into private equity. This is all about, as you say, an AIM Plus strategy. It's wholly additive. It's moving from AIM to AIM and private equity, which has to be a good thing. So, and it's also interesting to point out that the former fund manager also recognized that AIM alone was not a viable strategy, investing in one transaction alongside Maven, but also investing in a number of pre-IPO transactions with limited rights, which did not end well. There were significant losses on those transactions. So it's important, I think, to explain to shareholders that this is a very considered, gradual process. We would absolutely retain the core portfolio, the core older portfolio, but supplement that with newer, highly curated private company opportunities. And any companies that were sold, assuming that generated proceeds would be available to enhance dividends to shareholders. So we plan, an approach where we will be slightly adjusting the existing portfolio to eliminate some of the older, poorer performing companies. We will be bringing in better, larger companies, private companies into the portfolio to give that hybrid approach. And we will be looking where possible to optimize dividends to shareholders.
What's to stop another outfit from carrying out exactly that strategy? You even hinted that the previous fund manager had started to embark upon that.
Yeah, it's very difficult to, and I saw this before in 2008, 2010, at the time of the great financial crisis. We saw AIM-focused fund managers in a difficult market, recognizing at that time that AIM only was not a credible strategy. We saw managers embarking into investing in private company transactions. Now, the skills required to deploy capital in AIM and private equity are very different. You require a dedicated team to do that. We have that, and Amati do not have that resource in place. We've got a large team of focused private equity executives. That's all they do, making and managing investments in private companies. And private equity offers a number of advantages to AIM. If you look, for example, at performance of private equity over the last few years compared to AIM, performance has significantly diverged. Private equity has been much better than AIM. But there are important advantages in private company transactions, structural advantages, which help cover the downside, in particular for investors. For example, in private company deals, we're able to take certain preferences, either a downside liquidation preference or participating preference. We normally get a seat on the board. We also agree a detailed investment agreement with the company, which gives us protections. You don't have that with AIM. You are exposed to the vagaries of the market. And if an AIM investment goes wrong, a manager has very little influence in terms of being able to correct the problems. How
much of this, Bill, is to do with the performance of the AIM market in general, rather than just what happened specifically in the case of this company?
Well, there's no doubt, Guto, that the AIM market has been extremely difficult in the last few years, and really I have some kind of performance stats for you, which I think make will make very interesting listening. The market as a whole is down a third since 2021, which is, extremely bad news. But behind that, there are some even worse stats for AIM. There have been 92 large transactions since 2018, and the average return to investors is minus 60%. Since 2018 as well, 40 of the 92 companies that came to AIM have gone bust or are down more than 90%. So by whatever measure you look at this, the quality of companies coming to AIM or raising money on AIM since that time has been extremely poor. And there's a really important point to make in relation to this, in that whilst private equity has, subject to the investment meeting the qualifying requirements, has a large cohort of investments it can look at. AIM also has to meet the qualifying requirements before an AIM fund manager can invest. It is not a whole of market product. So no matter how good a manager is, and the early performance of the Amati AIM VCT was good, a manager is limited to the companies that come to AIM and that are available to invest in. And there is a structural issue within AIM insofar as if a manager is unaware the size of the market in terms of future deal flow, future qualifying deal flow, they may be disincentivized to take realizations. And that is another issue that has impacted shareholders in the Amati, now Renovar VCT. Amati previously had embedded gains of well in excess of 100 million, but only took around 10 million of those gains. And those gains have now reversed entirely. So a combination of poor deal flow, asset selection of investments where we declined most of those, and a failure to take returns, to take gains, compounded by a strategy to invest in private company deals without a team to do that, have all combined to impact performance negatively.
And you don't think the market's going to bounce back because, as you say, there are structural issues, there have been, changes in the rules, and it's a different game now.
Sad to say, Guto, I don't think an AIM-only strategy works anymore. It's not a viable investment strategy for AIM. As I said, the quality of companies seeking capital, qualifying capital on AIM has declined significantly, evidenced by the fact we have declined most opportunities over the last 3 years. And if you look at the outlook, unless there's a legislative change in some way, we don't see that changing. That the available IHT relief on AIM has reduced. AIM is seen as expensive for companies to IPO on. The quality is just not there at the moment. And, you could argue that the market will bounce back, but there are delistings as well. There's been a number of articles recently highlighting the number of companies leaving AIM. So the available landscape of companies to invest in at the moment is poor, and there's no sign of that improving in the short term. That's why we believe that an AIM-only strategy is no longer viable, and why the previous fund manager also recognized that by beginning to invest in certain private companies. The best approach for investors is the hybrid AIM and private equity strategy. And it's important to stress that our plan for this VCT is not to move from AIM to private equity. It's to move from AIM to AIM and private equity. In other words, to be wholly additive. But that will require a vote by shareholders to change the investment policy. But I stress, it's wholly additive. It's not one or the other. It's moving to be able to invest in a larger landscape of companies, which are evaluated, executed, and managed by a team with an expertise in that sector.
No doubt challenges in the market, but you think that shareholders were particularly shortchanged over this period?
Well, look, it's for shareholders to determine if they feel they were shortchanged, as you've described it, Guto. But we've prepared a slide that shows, graphically, the level of cumulative management fees relative to performance over the last 4 or 5 years, in fact, since January 21. And hopefully that speaks for itself. It shows cumulative fees increasing and performance declining. And arguably that may well be a reason why the board decided it had to act.
There were some pretty hefty fees in there too.
So the management fees for the VCT were 1.75% a year, which, you know, is not unreasonable for the sector. That would be what I would expect to see for an AIM VCT. In addition to that, the former fund manager was paid a termination fee of 1.1 million. What we're offering to do, or what we've agreed to do as part of our appointment as fund manager, to show our commitment to the turnaround project and to reposition the VCT in the way that I've described, is to manage the VCT for no fees, no management fees for 2 years. And as I said, that shows that we are committed to this project. We'd like to take it on, and we'd like to improve returns for shareholders over the medium term.
What critics say, of course, is that whether you've got a good pitch or not, shareholders were sort of blindsided. They were not given an opportunity. They were not given a voice. They were not consulted. Surely that's a reasonable point to make.
Well, I understand why that point has been made, but if you look at standard practice within the investment trust sector, this is a reason why companies, investment companies, appoint expert independent boards. It is their role, and it's absolutely normal and standard practice for a board to select the investment manager and at times to terminate the investment manager. There were 4 similar cases in 2024, and none of those went to a shareholder vote. What did go to a shareholder vote, which I understand and respect, is the change of investment policy. But on the issue of the investment manager, that is a board reserved matter, and that is a long established principle within the investment trust sector.
So what should shareholders do now?
Well, shareholders have to exercise shareholder democracy. They should read the circular. They should also read the document that Maven has prepared that explains its assessment of historic performance and how it would turn around the VCT. And it should vote accordingly, or shareholders should vote accordingly. They can either vote with the requisitioners, but that would involve appointing a board, none of whom have been involved in the board or on the board of a VCT, including the former fund manager, or they can vote to re-elect the independent experienced board, including a chair who's been a chairman of 4 separate VCTs, and a board that has a breadth of knowledge across investment banking, finance, corporate finance, and ultimately shareholders will decide the outcome.
And the choice, how would you characterize it? Some people talk about a sort of retreat or a sort of recovery. Is that a good way of summing up the choice as you see it?
Well, I think it's a reasonable description. The requisitioners' proposal is to gradually wind down the VCT, not to make new investments and to pay out proceeds to shareholders. Our proposal is effectively the same. We will be looking to realise some of the underperforming parts of the portfolio. We'll be looking to maximise dividends, as we always do. We've recently increased our dividend, our target dividend, across the Maven VCTs. We have a history of paying, special or enhanced interim dividends. So we will be doing exactly that. We will be maximising short-term returns for shareholders. But as you say, Guto, we'll also be looking at a recovery. We'll be looking to rebuild the VCT in a way that we've done in another case with highly curated private company opportunities to build a bigger, better, and more diversified portfolio that ultimately can improve shareholder returns.
And you sound pretty confident you can pull this off, even in the current market as it is, with all the challenges we've discussed.
Well, it won't be overnight. It won't be overnight, but we have done this before, as I've explained earlier. We have a track record of taking on a VCT that was in a near identical position, of having suffered a significant loss of shareholder value through a difficult AIM market and trying to move into private equity without a team. We have repositioned that VCT significantly. We've generated an improvement in total return in NAV of 84%. And that VCT stands as testament to what can be achieved with an effective hybrid AIM and private equity strategy.
Thank you very much for your time.
Thank you.